Hello folks, Steve Lentz here with the Morning Market Huddle. Today is Tuesday, July 22nd. Presented material is for educational purposes only and should not be construed as personalized financial advice. Options trading involves substantial risk that we should all understand before embarking on options trading endeavors. Folks, let's go straight to the S&P 500 press box. Okay, let's take a look at the weekly chart. And what we're going to do is take a look at this. We'll look at some earnings. Then we'll come back to the S&Ps and look at a bullish trade in the spiders. In the spiders, by the end of this 10-minute presentation, you'll have a real good credit spread trade to put on in the S&P, at least paper trade. I can't tell you how many lots to trade, if any. Of course, this is an educational presentation. But take a look at the wonderful candle reversal pattern that we have going on here from last week. You see that there? That is a nice tail where the price came down, way below the Bollinger Band, and then rose up and closed way above the Bollinger Band. And when you combine that upward price movement, that nice pattern, with the MACD divergence that we've talked about in the past, you have a real good setup with a probable bullish behavior in the future. Okay? And what we're looking for is some choppy behavior and then some bullish behavior moving forward. Also, look at the stochastic crossover down here. Notice in the past, when we've had the stochastic, the 14-period cycle go into oversold territory and then turn up, that corresponds with the market bottom. Look at this. Very nice. So we have a real good high probability setup for bullish behavior moving in the future here. On the point and figure chart, looks like the trend line is barely holding. We would need to write in another zero here before we are really going to label the S&P as a bear market. Okay, it has to fully clear the trend line before we declare this a bear market technically in the point and figure in a pure sense. Okay, going to earnings, let's look at today's earnings plays. This is a list of stocks that trade at least $100,000 in options that are priced over $10, and they're coming out with earnings either after the market close or before the market open tomorrow. Here you have a complete list. You can go ahead and pause if you want and write these down. We are interested mostly in those here that are high flyers. High flyers, stocks that have perhaps doubled in the last year, and those are the first three on the screen that you'll see. ILMN, NBR, and ABFS. Arkansas BF. ABF is a trucking firm, and let's dial that one up. Here's a price chart. And you can see the last earnings, we had a nice gap and a run. Also, we have a nice gap and a run. When we look at the earnings movement, this is a screenshot from the Discover Options mentoring site for our students. We can show you each earnings that have come out in the past as well as the movement. Here we had a gap up of 13%, closing up 16%. The previous earnings, ABF gapped up 11% and closed up 16%. So we're looking at some pretty strong movement here coming from earnings here tomorrow. What we can do here in the options world, how can we exploit this thing? Well, we know that in the last two earnings sessions, earnings announcements, this stock has gapped and then it's run. It's run for several days after that. So how would you play this? Well, what you could do is a long strangle. That means that you're going to buy a long call. You're going to go long a call and long a put. And because the price of the stock is in between strikes, 42.5, we have a strike at 45 and 40. There is no 42.5 strike. That means for us to put on a neutral trade where we're going to be long a premium in both directions, we have to split the strikes and put on a long strangle. Now the idea here, after earnings comes out, stock gaps, you're going to dump the losing side. So if it gaps up, you're going to sell the put for whatever you can get and then ride that call up, maybe with a short with a pretty close stop loss, maybe at the previous day's low. And of course vice versa, if it gaps to the downside, then dump the call, ride the put on down with a nice stop loss maybe at the previous day's high. Something like that. All right, in the past that would have worked, we can see, but let's just see what happens here in the future with this one. It's an interesting little spec play. You know, we'll just see how this pans out. This is the strategy as it works out on the risk graph, and I'm including here a real strong decline in that front month implied volatility. You could see that the vols here in the front month are very high compared to the September options, and so these are going to really come off quite a bit. And so we're modeling that here in the graph, and the break even here right at the outset is pretty far to the downside. The upside, we can show that if it moves at the same level it's had in the past, then we would actually make money here. The downside, it's kind of a wash. But again, we're playing the, we're going to drop the losing side and run with it. Little interlude here. Discover Options is a mentoring company. We have a nice 6-page brochure you could call and ask us about. We can email it to you. Just email me, steve@discoveroptions.com. If you want, give me a call. We could set up an appointment, and we'll explore whether our mentoring program is a match for your situation there. Let's take a look at a long trade in spiders, a bullish trade. Back to the S&P 500 chart. Notice on the weekly bar chart, I'm showing you the implied volatility of the options in the blue line and the statistical or actual volatility in the red line here of the underlying asset. And in the past, and let's go back to say 2004, notice that when the volatilities peak and you have a close under the Bollinger Band, okay, that there's bullish movement occurring after that. And typically you have to wait until a weekly high price is exceeded the next week. So if price exceeds the previous week's high after this price closes below the Bollinger Band and you have a peak in volatilities, you want to wait until the weekly high is penetrated by the next week. Then you have a good likelihood for choppy behavior and then a bullish run. Okay, here we just have a bullish run up right there. But you can look at this pattern. It's fairly reliable. Choppy behavior, then a run. Okay, this one didn't quite close, but still we had a nice run, choppy behavior and a run, etc., etc. So if we were to put on a bullish trade in the spiders, we might want our stop loss to be right at that 120 mark. If it goes down below 120, I think we can conclude that our bullish bias is pretty much shot and out the window. We're going to pull the trigger and get out right away. Don't ask questions, don't look back, don't do anything, just get out at that point. What would we do here? At the 120 mark, one strategy, our bread and butter, is to do a bull-put spread, putting the short strike right at our stop loss at 120. And if we did that using yesterday's theoretical prices, we would collect about a 36-cent credit for every lot that we trade. What that works out to is about 22% or so off of the net required. You can see here we're going to make 22%. Okay, off the net required for every one lot that we do trade. Watch if the market does go, if the spiders go down to that 120 mark, we would lose about as much as we could make. Not too bad. 1-for-1 reward to risk ratio, yet our probabilities are at 80%. Now that's at expiration, of course. What is the raw statistical probability of that 120 ever getting hit between now and 26 days out? We have a probability calculator here. This is free at discoveroptions.com. Notice the probability of that 120 mark ever getting touched is at 37.8. We're looking at about a 62% probability that that 120 will never get hit. That's just a random raw statistical probability, and combined with the 1-for-1 reward to risk ratio, the odds are in our favor. Plus, if our technical analysis is any good at all, we have a significant trading edge. Folks, we're discoveroptions.com. We offer you the finest options trading curriculum available anywhere, private sessions with a veteran market maker consistently while you go through the curriculum. We'll help you develop a trading plan, and we specialize in both directional and non-directional strategies. Give me a call, shoot me an email. Let's explore whether this is right for you. Folks, have a great week. We'll talk to you on Thursday as well. Take care.